Day trading is a scam. It loses you money. It's all smoke and mirrors. That's what people say, and if you've never looked into it seriously, it sounds about right. But here's the thing. Handing someone who has never sat behind a wheel a set of car keys and saying drive doesn't prove that driving doesn't work. It proves that they don't know how to drive yet. Day trading is identical. Most people blow their first account not because the market is rigged against them, but because they got in the car before they knew how to steer. So before we touch a single chart, let's make sure you actually know how to drive. This guide breaks down into 7 parts, a distillation of the things that actually matter, explained simply, so you can start with the right foundation instead of learning the hard and expensive way. Let's get straight to it. The first thing we need to talk about is mindset, because wrong mindset kills accounts faster than bad strategy ever will. Here's the most important reframe in trading, and almost nobody says it clearly. The goal of day trading is not to make money. It's to accurately predict with high probability where price wants to go. Money is just the side effect of doing that consistently. If you open the charts every morning thinking, how do I make money today? You'll overtrade, force setups, and blow your account. But if you open them thinking, where does price want to go based on what I'm seeing? Everything changes. You start filtering out bad trades. You start waiting for real setups, and the money follows. The second mindset fix. Losing a trade does not mean you did something wrong. This sounds insane, but it's mathematically true. You don't need to be right most of the time to be profitable. You need to control how much you lose when you're wrong versus how much you make when you're right. We'll prove that with numbers in a moment. Third, making money on a trade doesn't make it a good trade. If you broke your rules, got lucky, and closed green, that's not a win. That's a ticking time bomb. Because the next time you break your rules, the market won't be so generous. Get these 3 things in your head before anything else. Strategy is almost irrelevant until your mindset is right. Now let's move on to part 2, to what day trading actually is. Day trading means entering and exiting trades within the same day, sometimes within minutes, sometimes within hours. You're not buying and holding for months like your parents did with their retirement fund. You are predicting short-term price movement and capitalizing on it in both directions. Both directions. That's the part most beginners miss. When price goes up, you go long. You buy, price rises, you sell higher and pocket the difference. When price goes down, you go short. You sell first, price drops, you buy back cheaper and pocket the difference. This means a market crash isn't necessarily a disaster for a day trader. It can be an opportunity. And here's the single biggest advantage of day trading over every other online income method. It's infinitely scalable. E-commerce is capped by your niche, your audience, your inventory. Copywriting is capped by the number of clients you can serve. Day trading is only capped by your capital, and there are prop firms that will give you their capital to trade once you prove you can do it. The skill itself has no ceiling. Now let's talk about part 3, what you'll actually be trading. There are 5 main markets: Forex, futures, crypto, stocks, and options. The core skill, reading price action, transfers across all of them, so don't get overwhelmed by the variety. Start with one and go deep. Forex, the foreign exchange market, is the largest in the world, moving roughly $7.5 to $8 trillion per day. It's open 24 hours a day, 5 days a week, accessible with as little as $50 to $100, and offers significant leverage. For most beginners, it's the best entry point precisely because the capital requirement is so low. Futures, instruments like the S&P 500, ES, NASDAQ, NQ, gold, GC, and natural gas, NG, are highly liquid and excellent for technical trading. NQ and ES move fast, which is exciting but unforgiving when you're still learning. If you want to start on futures, natural gas tends to move slower and gives you more time to think. Crypto is volatile, open 24/7, and has no central exchange. It's good for catching big moves, but the seasonality and manipulation make it a harder environment to learn in. Get the skill down somewhere else first, then bring it here. If you're not sure where to start, keep it simple. Euro USD on the Forex side, smooth, liquid, slow enough to follow, or ES and NG on the future side, depending on how much movement you want to deal with early on. Now let's speak about trading sessions. The market doesn't move the same way at all hours. Institutional money, the banks and funds that actually move price, operates on a schedule. You need to know when they're active. There are 4 main sessions. London runs from 2 a.m. to 11 a.m. Eastern Standard Time and is where GBP pairs come alive. New York runs from 8 a.m. to 5 p.m. EST and carries the highest volume of the day. Then there's the overlap. That window between 8 a.m. and 11 a.m. EST where London and New York are both running at the same time. 3 hours, that's it. That's where most of the money is made, across almost every instrument every single day. And then there's Tokyo from 7 p.m. to 4 a.m. EST. Low volume, slow movement, not the place to be when you're starting out. Now, before we get into the charts themselves, you need to figure out what kind of trader you actually want to be. There are 3 types. Scalpers are in and out in seconds to 5 minutes. High frequency, fast decisions, a lot of noise. Not the best starting point. Intraday traders hold trades anywhere from 15 minutes to a couple of hours. This is the sweet spot for most beginners. Enough time to think, not so much that you're glued to the screen all day. Swing traders hold for hours or even days, which means less screen time, but a lot more patience required. Now let's move on to part 4. Because this is where things get genuinely interesting. Most beginners assume that to make money trading, you need to be right most of the time. That's completely wrong, and the math proves it. Say you take 10 trades and you lose 7 of them. Each loss costs you exactly $50, but your 3 wins return 6 times, 4 times, and 3 times your risk. Loss side, minus $350. Win side, plus $650. Net result, $300 in profit, losing 70% of the time. This is why being right is the wrong goal. What actually matters is the ratio between your average win and your average loss. A trader winning 30% of the time with a 4-to-1 reward to risk ratio will outperform a trader winning 60% of the time at 1-to-1, every time. Which brings us to position sizing, the one calculation that separates professionals from gamblers. Every trade starts with one question. How much am I willing to lose if I'm wrong? Pick your dollar risk, say $50. Identify your stop loss level, the exact price where your trade is clearly wrong. Subtract it from your entry. Divide your risk by that difference. That number is your position size. Entry at $42,800. Stop at $42,780. Difference of $20. Risk of $50, position size of 2.5 units. You know exactly what you're risking before you click buy. Every time, no guessing. Part 5 is about the charts themselves. But first, thank you to this incredible community. The most heartfelt comments will get a special reward. Your support is what keeps this channel alive. This week's winner is this comment right here. Please reach out to my email to claim your free month of Flux charts. Now, if you haven't heard about Flux charts yet, this is the platform I use every single day for my trades. It completely changed how I trade. Flux can run screeners on up to 15 tickers and timeframes at once, so instead of flipping through charts, it tells me exactly where my setups are happening. They have backtesting tools to build custom strategies and test them against years of market data in seconds, so you know if a strategy works before risking any money. Here's the best part, 90% of their indicators are completely free. Plus, you can use Flux charts even with the free version of TradingView, which is huge because you can use multiple indicators simultaneously, avoiding TradingView's 2-indicator limit. They also host daily live trading classes teaching strategies, risk management, and trading mindset. Can't join live? They have a full library of recordings. Click the link in my description and use this code to discover the fantastic promotion I got for our community. Alright, let's get back to the video. The chart is a visual representation of mass human psychology. Price goes up when buyers outweigh sellers. Price goes down when sellers outweigh buyers. The market moves to fill imbalances caused by supply and demand. Everything else, every indicator, every tool, every strategy, is just a more refined way of reading that same dynamic. There are 2 types of analysis. Fundamental analysis covers news events, earnings reports, interest rate decisions, the real-world things that move markets. As a day trader, you don't need to trade the news, but you need to know when it's coming so you're not caught on the wrong side of a spike. Technical analysis is reading the chart itself. Patterns, levels, price action. That's your primary weapon. And it starts with the most basic question of all. How do you actually read a chart? Most beginners use line charts. That's their first mistake. Most beginner traders ask me this question all the time. Why can't I just use line charts? Wouldn't that be simpler? Here's what they don't understand. Line charts only give you one piece of information, the closing price for each period. That's like trying to drive a car with your eyes closed. But candlestick charts, they reveal 4 critical pieces of market intelligence that can make or break your trades. Let me break this down for you using a real example. On the left, we have the basic line chart, and on the right, the candlestick chart. Notice how both charts follow a similar pattern, but watch what happens when we dig deeper into the data. The line chart shows us that price hit a support level and bounced. That's all we know. But when we switch to the candlestick chart, a completely different story unfolds. The candlestick reveals that price actually broke below the support level at one point, as shown by that long lower wick, before buyers stepped in and drove it back up to close at the key level. This is absolutely crucial information that line chart traders miss completely. These hidden details can tell us exactly where price might go next, and that's why professional traders always use candlesticks. Every single candlestick tells a story about the battle between buyers and sellers. Green candles form when the closing price is above the opening price, showing that buyers dominated sellers during that period. Red candles are the exact opposite. Sellers overpowered buyers, pushing the closing price below the opening. But here's where it gets really interesting. The size and shape of these candles reveals the intensity of this battle. A candlestick has 2 main components, the body and the wicks, also called shadows. Large bodies tell us about dominance. When you see a green candle with a massive body, buyers weren't just in control, they completely overwhelmed sellers with minimal resistance. The price opened lower and buyers pushed it up significantly before the candle closed. It's the same story with large red bodies, but with sellers in complete command. Small bodies reveal a different type of market, one where neither side could gain decisive control. Even though buyers might have won slightly, sellers put up strong resistance, keeping the price movement limited. The wicks are where things get really fascinating. A long lower wick shows that sellers initially pushed price down hard, but buyers fought back with such force that they drove price significantly higher before the candle closed. This indicates strong buying pressure at that level. A long upper wick tells the opposite story. Buyers tried to push price up, but sellers rejected that move with authority and drove price back down considerably. This shows powerful selling pressure. When you see a candle with a small body and equal wicks, that's the market telling you that neither buyers nor sellers could establish control. It's like watching a tug of war where both teams are perfectly matched. Now let me show you the 13 candlestick patterns that actually work and have consistently made me money throughout my trading career. I hope you guys will get some value out of this and will learn something new. If you do, I would really appreciate it if you would take 5 seconds to like this video and write in the comments where you're trading from. The first pattern I want to show you is the breakout candle. This is one of the most explosive patterns you'll ever see on a chart. The breakout candle pattern occurs when you have multiple small candles with tiny bodies consolidating sideways, followed by one massive candle that breaks out of that consolidation. This pattern shows that price was stuck in indecision with no clear direction until one side, either buyers or sellers, gained enough strength to push price significantly in their favor. The series of small candles represents consolidation, while the large candle is your breakout signal. For this to be valid, you need at least 3 consolidation candles, but the more you have, the more powerful the eventual breakout becomes. The bullish breakout pattern shows a large green candle breaking upward, while the bearish pattern shows a large red candle breaking downward. The color of the consolidation candles doesn't matter. What matters is their small size. When you see this setup, you can enter a position in the direction of the breakout candle at its close, with your stop loss placed at the opening price of the breakout candle. My absolute favorite and most used candlestick pattern I trade with is the engulfing candle. This pattern consists of 2 candles, a smaller first candle followed by a massive candle of the opposite color. The key requirement is that the second candle's body must completely swallow the first candle's body. There are 2 types of engulfing patterns. The bullish engulfing appears when a small red candle is followed by a large green candle that completely engulfs it. The bearish engulfing is the opposite, a small green candle followed by a large red candle. Here's a perfect example of how powerful this pattern can be. Notice how price approaches this strong support level where it had bounced multiple times before. We can expect another bounce, but we need confirmation before entering. That's exactly when this incredible bullish engulfing candle forms right at the support level, completely consuming the previous red candle. This demonstrates incredibly strong buying momentum, and we can be highly confident that price will continue moving upward from this level. We can take a long position at the closing price of the large green candle, with our stop loss positioned at the bottom wick of that engulfing candle. The bigger the engulfing candle, the higher the probability of a successful reversal. The third pattern I want to show you is the pin bar. The pin bar is a single candlestick pattern that can give you laser precise entry points. This pattern features a small body with one dramatically long wick pointing in one direction. A bullish pin bar has a small body with a long lower wick, showing that sellers initially drove price down hard, but buyers rejected that move and pushed price back up before the close. This demonstrates that buyers are gaining control at that level. The bearish pin shows the opposite story. Buyers pushed price up, but sellers stepped in with such force that they drove price significantly lower before the candle closed. Here's the crucial part that most traders get wrong. I never enter immediately when I see a pin bar. Instead, I wait for additional confirmation. For a bullish pin bar, I want to see another green candle form, confirming the upward momentum. Only then do I take a buy position, with my stop loss placed at the bottom of the pin bar's long wick. Moving on to pattern number 4, the multiple wick pattern. This is one of my personal favorites because it usually holds true on charts and is surprisingly simple to identify. The multiple candlestick pattern occurs when you have 3 or more candles with wicks pointing in the same direction. I love pairing this pattern with support and resistance levels. When you see multiple candles with downward wicks forming exactly at a support level, it tells you that sellers keep trying to break that support, but buyers are fighting them off and winning every single time. This confirms that the support is legitimate and price has a strong chance of bouncing upward. The more candles with wicks in the same direction, the better the probability that price will respect that pattern. At resistance levels, multiple candles with upward wicks show that buyers are trying to push higher, but sellers keep rejecting those attempts, making it a great short entry opportunity. Next, we have the 3-bar continuation pattern. This is one of my secret weapons for catching trending moves that most traders completely miss. The 3-bar continuation pattern consists of 3 consecutive candles that must form in a specific sequence. The second candle is a smaller, opposite-colored candle that ideally shouldn't exceed half the size of the first candle's body. The third candle should be another large candle that closes higher than the second candle's close. The bullish version has large green candles as the first and third, with a small red candle in the middle. The bearish version uses large red candles with a small green candle in between. This pattern is absolutely incredible for continuation trades. When you see this formation during an existing trend, it signals that the trend is likely to continue with renewed strength. For a bullish pattern, you can enter a long position at the close of the third candle, with your stop loss at the bottom wick of the second candle. The sixth pattern is the 3-bar reversal. While the 3-bar continuation helps you ride existing trends, the 3-bar reversal pattern helps you catch trend changes before they happen. This setup consists of 3 candles in sequence. The second candle is smaller with the same color and a small body. Here's what makes this pattern so reliable. The size of the third candle determines the success rate. If the third candle's body is equal to or larger than the first candle, you're looking at a high probability reversal signal. If it's smaller, the signal is weaker. The bullish 3-bar reversal shows 2 red candles followed by a large green candle. The bearish version shows 2 green candles followed by a large red candle. During a downtrend, when you spot a bullish 3-bar reversal, you can enter a buy position at the close of the third candle, with your stop loss at the lows of the second candle. Let me show you pattern number 7, the momentum candle. The momentum candle is one of the easiest patterns to spot because of its sheer size. This pattern consists of a single candle that's 2 or 3 times bigger than the previous candles before it. This candle is incredibly powerful because most of the time after it appears, price continues moving in that same direction. The most effective way to use this pattern is in choppy, sideways markets where price has been moving without clear direction. Here's why this works so well. When markets are moving sideways, there are tons of traders stuck in losing positions. When a sudden momentum candle breaks through these levels, all those stop losses get triggered, adding massive fuel to the price movement and creating a cascade effect that pushes price even further in that direction. Next, we have the doji candle. The doji candle is one of the most important reversal indicators you need to understand. This candlestick has an extremely thin body with wicks extending from both sides, representing market uncertainty and indecision. What makes this candle so powerful is that it shows neither buyers nor sellers could gain control during that period. When there's uncertainty in the market, price often reverses in the opposite direction of the previous trend. There are several variations of the doji: the regular doji, the long-legged doji with larger wicks, the dragonfly with a small body and big bottom wick, and the gravestone with a small body and large upper wick. All of these signal the same thing, a potential price reversal. Here's my strategy for trading doji candles. After I spot one, I wait for 2 or more candles of the same color to confirm the reversal direction. For example, if I see a doji during a downtrend followed by 2 green candles moving upward, that confirms the reversal and gives me confidence to enter a long position. Pattern number 9 is the hammer. The hammer is usually a candle that has a decent sized body and a long lower wick. What this candle tells us is that sellers managed to push the price way down, but then buyers absorbed all that selling pressure and drove the price back up significantly before the close. This is typically an extremely bullish sign and shows us that buyers are gaining strength at that level. Next up is pattern number 10, which is the shrinking candle pattern. This pattern is like watching a trend slowly lose its power before completely reversing direction. The shrinking candle pattern consists of at least 3 consecutive candles of the same color, each getting progressively smaller, followed by a large candle of the opposite color. This formation shows that the previous trend is gradually losing momentum, as indicated by the shrinking candles. Then the large opposite color candle appears, confirming that the other side has taken control and the reversal is underway. The size of the 4th candle is absolutely critical for success rate. Larger candles indicate stronger momentum and higher probability of reversal. I recommend looking for patterns where the 4th candle closes above the 2nd candle for maximum effectiveness. For a bullish shrinking pattern, you'll see 3 red candles getting smaller, followed by a large green candle. You can enter a long position at the close of the green candle with your stop loss below the previous candle's low. Pattern number 11 is the Marubozu. The Marubozu is a powerful trend continuation signal. The bullish Marubozu is a large green candle with no wicks whatsoever, basically just a big green rectangle. This means the opening price was the exact same as the lowest price of that period, and the closing price was identical to the highest price. This candle shows that buyers had complete control from the very beginning to the very end of that trading period. There was no resistance from sellers at all. This is typically seen in the middle of strong trends, confirming that the trend will continue moving in that direction. The bearish Marubozu works the same way but in reverse. A large red candle with no wicks, showing sellers had absolute dominance throughout the entire period. When you see a Marubozu candle in the middle of an existing trend, it's usually a strong signal that the trend will continue with even more momentum. Moving on to pattern number 12, the shooting star. The shooting star works just like the hammer, but it has the long wick on the opposite side, at the top. This candle shows that buyers initially pushed price up hard, but sellers stepped in and rejected that move, driving price back down considerably before the close. You should trade this exactly like the hammer, but in reverse. When you see a shooting star, it's usually a strong indication that price will start reversing downward. The last and final pattern I want to talk about is the tweezer pattern. This formation consists of 2 consecutive candlesticks, a red candle followed by a green candle, both having similar wicks pointing in the same direction. If you see this pair with both candles having wicks on the bottom, you can have a pretty strong indication that the chart is about to move upwards. Let me show you how this works. Notice how price approaches this support level where we see a red candle with a long wick at the bottom, right at the support. Then we get a green candle that also has a wick heading downwards at the exact same level. This tells us that price is respecting this support area and is now building momentum to move upward. This creates an excellent buying opportunity. The bearish tweezer works in the exact opposite way. You want to see a green candlestick followed by a red candlestick, both having wicks pointing upward at the top. When you spot this pattern at resistance levels, it's usually a strong signal that price is about to reverse downward. Now here's where most traders fail. They try to trade these patterns in isolation, but if you want to achieve consistent profits, you need to combine these patterns with other forms of analysis. What other forms of analysis? Key levels. Specific zones on the chart where price tends to react every single time. 4 types matter the most. Support and resistance. These fundamental price zones represent horizontal levels, where price has previously bounced and might bounce again in the future. When a level sits below current market price, we identify it as support, a potential buying zone when price approaches. When a level sits above current price, we call it resistance, a potential selling zone when price reaches that area. Trend lines. These diagonal reference lines form during trending market conditions and help you identify the overall price direction. An ascending trend line indicates bullish market sentiment, while a descending trend line reveals bearish sentiment. Just like horizontal support and resistance, trend lines create excellent entry opportunities. When price pulls back to touch an upward trend line, it often provides an ideal buying opportunity within the larger upward movement. Dynamic support and resistance. This advanced concept works similarly to traditional horizontal levels, but instead of using fixed lines, it employs moving indicators like moving averages to create dynamic price zones that adjust with market movement. Fibonacci retracements. This powerful tool creates horizontal reference lines using those mathematical Fibonacci sequences you might remember from school. These magical numbers transform into critical price zones, where the market often decides to change direction. Here's your step-by-step process. Start by spotting the highest peak and lowest value on your chart during a significant price movement. Once you've identified these two extreme points, simply connect them using the Fibonacci tool by dragging from the bottom to the top. Now watch the market for the pullback. Here's where it gets exciting. Price will often bounce right off the 0.382 level like it hit an invisible wall. This particular zone has an incredible record for catching reversals, which is why smart money always watches it closely. When you see price approach that 0.382 zone, that's your moment to consider a buy opportunity. But remember, the market isn't always predictable, so price might also react at the other Fibonacci levels. That's why professional traders stack multiple confirmation signals before pulling the trigger on any trade. Let me show you the exact advanced strategy I use to achieve strong returns year after year. First, you want to focus on higher time frames. Any time frame at or above the 1 hour chart works much better. Candlestick patterns are significantly less effective on lower time frames, so this is absolutely crucial for your success. The first step is identifying a key level on your chart. These could be support and resistance levels, dynamic key levels, trend lines, Fibonacci levels, or other significant price areas. For this example, let's focus on support and resistance levels and trend lines. Look at this chart where price has formed a clear downward trend and bounced twice at a specific area, creating a solid support level. Now we wait for price to interact with this level once again. At this third approach, we're expecting another bounce, but we need confirmation from a candlestick pattern that supports our bullish bias. Notice how we get a large red candle, followed by a smaller red candle, then a large green candle that closes above the body of the first candle. This matches perfectly with our bullish 3-bar reversal pattern, suggesting that price will reverse to the upside. You can enter a buy position at the high of the third candle, place your stop loss at the low of the second candle, and set your take profit target at twice the size of your stop loss. As you can see, price moved up exactly as predicted and hit our profit target. Here's another powerful example using confluence levels. In this chart, price is in a downward trend and has formed a support turned resistance level. This happens when price initially respected a level as support, but then broke below it and is now approaching it again from underneath, making it a resistance level. But notice something even more significant. Price has also created two lower highs, forming a strong downtrend line. The area where this trend line intersects with the resistance level is called a confluence level, an area where multiple key levels meet. Price is much more likely to reverse at confluence levels because you have multiple technical factors working together. When price reaches this confluence zone, we see 3 green candles each getting progressively smaller, followed by a large red candle. This shrinking candle pattern shows that buying pressure was fading as price approached our confluence level, giving sellers the perfect opportunity to take control. This setup provides an excellent short entry opportunity. You can place your stop loss above the high of the previous candle and set your profit target at twice the size of your stop loss. The price moved down exactly as anticipated and reached our profit target shortly after entry. Even though I recommend trying to memorize these patterns so you can spot them instantly, I completely understand that it can be challenging to remember what they look like, especially when you're starting out. Well, here's something that will make your life so much easier. There's actually a way to have your chart tell you exactly where these candlestick patterns occur, which makes spotting them incredibly simple and you don't even have to memorize every single one. Here's how you do it. Just go to Trading View, click on the Indicators tab at the top, and then type in whatever candlestick pattern you're looking for. So for this example, let's search for bullish engulfing. Simply click on it, and Trading View will automatically mark every single spot on your chart where a bullish engulfing candle appears. This makes it extremely easy to identify these patterns without having to strain your eyes looking for them. But here's where it gets even better. You can add multiple candlestick pattern indicators to your chart at the same time. So you could have bullish engulfing, bearish engulfing, doji patterns, and hammer patterns all showing up automatically on the same chart. start. This way you can spot any of these high probability setups the moment they appear. This technique is incredibly powerful because it removes the guesswork and helps you focus on what really matters, confirming the setup with proper risk management and key level analysis. Instead of spending time hunting for patterns, you can spend your energy on executing perfect entries and exits. Candles tell you what just happened, but to know what's about to happen, you need to understand the structure underneath the candles. This is where smart money concepts come in. The same framework institutional traders use to move billions of dollars every single day. I'm going to reveal 6 core concepts that separate profitable traders from those who blow their accounts. The first concept we need to master is market structure itself. The market isn't random at all. Every movement you see on your screen can be broken down into just 2 fundamental behaviors. Understanding these behaviors is like having a roadmap to where price wants to go next. The first behavior is trending. This includes both uptrends, where price makes higher highs and higher lows, and downtrends, where we see lower highs and lower lows consistently forming. The second behavior is consolidation. Those choppy sideways movements where price seems stuck in a range. Here's what most traders don't realize. These phases work together like a continuous cycle. Price moves from downtrends to uptrends to consolidations and back again, constantly accumulating liquidity and institutional orders along the way. Price needs to consolidate between major trending moves. It's during these consolidation phases that smart money positions themselves for the next big move. When you open your trading platform, the very first question you should ask yourself isn't, where should I buy or where should I sell? The question is the market currently trending up, trending down, or consolidating? Get this wrong and you'll find yourself fighting against institutional flow. Get this right and you'll start trading with the smart money instead of against them. Now let me show you what an ideal uptrend looks like on your charts. In a perfect bullish scenario, you'll see price consistently forming higher highs and higher lows. Each time price breaks a previous high, it's telling you that buying pressure is still dominant. The uptrend continues as long as price holds above the major lows. An uptrend ends the moment price breaks one of those major lows to the downside. This isn't just a small retracement we're talking about. This is a complete structural break that signals the entire character of the market has shifted. Every time price breaks a major high to the upside, something incredible happens. You get what we call a break of structure, and this creates a demand zone associated with that BOS wave. Learning to identify these valid major highs and lows becomes absolutely crucial because it enables you to detect signals for trend reversals or continuations before they happen. Here's the reality that most textbooks won't tell you. It's extremely rare to find an uptrend in the real market that mirrors those perfect textbook examples. Price doesn't behave with that kind of mathematical precision. Real market movements are much more complex and dynamic. This brings us to what I call the realistic market structure. This is what you'll actually see on your charts day after day. Let me walk you through exactly how to navigate these more complex scenarios like a professional trader. Picture this. Price has been moving higher and suddenly breaks the previous highs to the upside. Now comes the million-dollar question. How do you identify which highs and lows are actually major structures versus just internal noise? Look at the left side of your structure. You'll notice price experienced an upward movement until it started to retrace. The highest point that price reached before that retracement movement began, that's your major high. The lowest point of the bullish wave that initiated the entire upward movement leading to the break of structure and new high, that becomes your major low. These 2 points create what we call the major external structures. Everything that forms between these 2 levels is considered internal structure, and here's why this distinction is so important for your trading success. If price breaks that major high to the upside, creating a break of structure, you're seeing a continuation signal. The trend is still your friend. However, if price falls below that major low, you need to start thinking about trend reversal. The specific internal price action that happens between those external structures doesn't matter nearly as much as whether price holds above that recent major low. After identifying those recent major external structures, you now have your current area of interest defined. This becomes your trading range. Watch what happens when price enters the retracement phase. During this retracement, price generates a series of internal structures, particularly bearish ones. Then something powerful occurs. After forming a bullish internal realignment, price breaks that recent major high to the upside, establishing fresh major high and low levels. Here's where it gets interesting for your trade entries. The newly generated major low becomes this internal low situated at the extreme. This low is considered major because it's the last low created before price initiated that upward movement leading to the break of structure. Why focus on this low as the major rather than this other one? This is because the low located at the extreme is the ultimate and lowest point before price initiates its upward movement, creating the break of structure. BOS. The second concept is the break of structure. Understanding BOS patterns will dramatically improve your trade timing and selection. There are specific rules that you absolutely must follow to identify a valid break of structure. Miss these rules and you'll find yourself entering trades just as smart money is preparing to move against you. A valid break of structure occurs when price breaks and closes above the most recent higher high with the body of a candle, not just the wick. This is crucial. We need that candle body to close beyond the previous high. This remains valid even if price immediately moves downward after breaking the structure. When this happens, price generates new major low and major high levels, establishing a completely new trading range. If price subsequently breaks this newly generated major low to the downside, it's signaling a potential trend reversal. This shift tells you that price is no longer bullish. We call this a change of character. But here's where many traders get trapped. If price breaks the recent higher high with a long shadow or wick, but the candle body immediately closes below the range of that high, and the subsequent candle's wick doesn't surpass the first candle's wick, we do not consider this a break of structure. In this scenario, we treat this low as an internal structure formed inside our trading range. To identify a legitimate trend reversal signal, you need to wait for price to break that major low located at the extreme, not the upper internal high. Let me show you another scenario that creates fantastic trading opportunities. If price breaks the recent higher high with a wick, and the first candle's body closes below the high range, but then the subsequent candle's wick exceeds that first candle's wick, now we can consider this a valid bullish break of structure. When this occurs, you have a newly formed major high and major low defining your updated trading range. The internal price action within this range doesn't dictate your trading decisions. As long as price remains above your newly generated major low, you're still in a bullish market environment. The only time you should consider a valid trend reversal signal is when price breaks that newly formed low to the downside. This creates what we call a valid change of character pattern, and this is the third concept every professional trader must understand. Chalk. The change of character is where most retail traders lose their money because they don't understand the difference between valid and invalid signals. Let me show you exactly how to identify legitimate change of character patterns like institutional traders do. To identify a valid change of character, as usual, you first need to determine the general market direction. Are we in an uptrend or downtrend? Once you've established this, you must highlight the valid break of structure points. In a bullish scenario, imagine price creating a series of valid breakup structures. The low and high from your first valid bullish BOS represent your major structures. Remember, any price action forming between these two structures is considered internal movement. Change of character patterns come in two distinct types, minor and major. Every time price breaks any internal low, it creates a minor change of character. Here's what you need to understand. A minor change of character alone cannot be considered a sign of market structure shift. This is where countless beginner traders lose their money. They see a minor change of character and immediately think the bullish phase has ended. They believe it's the perfect time to go short. These traders typically place their stop loss just above the internal high, expecting price to continue downward. But here's what actually happens. Price makes a brief retracement and then continues its bullish movement, completely destroying the stop losses of those short traders. They don't understand why their analysis failed, and unfortunately, they repeat this mistake over and over. What these traders missed is absolutely critical. Price never broke the major low to confirm a market structure shift. They shouldn't have entered a short position until price broke that last major low to the downside. Their identified change of character was invalid. Price was simply in its retracement phase before continuing in its primary direction. To get a valid market structure shift signal, you need patience. Wait for price to establish a major change of character by breaking and closing below that last major low that initiated the upward movement leading to the bullish break of structure. Here's the rule that will save you thousands of dollars in losses. In a bullish scenario, a change of character pattern is only valid when price breaks and closes below the last major low with the body of a candle, not just a wick penetration. If price breaks the most recent structure with a long wick or shadow, but closes within the highs range, then the change of character is invalid. You cannot consider this a market structure shift. Wait for proper confirmation before making your move. The same concept applies perfectly to bearish scenarios. For a valid change of character that provides high probability trading opportunities, you need price to break and close above the recent major high with the body of a candle. A simple penetration with a shadow or wick doesn't qualify as valid confirmation. Fair value gap. The fourth concept that will revolutionize your entries is fair value gaps. These powerful formations occur when price moves so aggressively in one direction that it creates an imbalance in the market structure. You can identify a fair value gap by looking for 3 consecutive candles where something specific happens. In a bullish move, the first candle's high doesn't overlap with the third candle's low. In a bearish move, the first candle's low doesn't overlap with the third candle's high. This gap represents an area where price moved too quickly, leaving behind an inefficiency that the market will likely revisit. But not all fair value gaps are worth your attention. There are 6 key factors that make a fair value gap valid and high probability for your trading success. First, the fair value gap must be unmitigated. This means price hasn't tested this zone since it was created. If price has already returned to fill the gap, it's no longer valid for entry purposes. You're looking for fresh, untested imbalances. Second, when price finally returns to the fair value gap, watch the reaction carefully. You want that reaction candle to either close inside the gap or close in the direction of your expected move. If price breaks through the gap with a strong body close, consider the FVG invalidated. Third, look for confluences. When your FVG coincides with support and resistance levels, trend lines, or other significant structures, this dramatically increases the probability of the gap holding and providing a successful trade entry. Fourth, prioritize your FVG selection based on market direction. In bullish scenarios, focus on lower FVGs. In bearish scenarios, prioritize higher FVGs. These typically offer much higher probability of holding when price returns to test them. Fifth, use the Fibonacci retracement tool to identify your highest priority gaps. Mark from the low to the high of the impulsive move. Focus only on FVGs in the lower portion for long entries and upper portion for short entries. Sixth, ensure there's a break of structure before the FVG formation. This confirms you're trading in the direction of institutional movement rather than fighting against the overall trend. Order blocks. The fifth concept that gives you institutional level insight is order blocks. These zones represent areas where significant institutional decisions were made, and understanding them gives you incredible insight into where smart money positioned themselves. We consider the last candle that created the inefficiency as the order block zone. This is where we believe the critical decisions were made during that specific candle formation. Sometimes order blocks appear at the start of impulsive moves, and sometimes they form in the middle of movements as candles with the same or opposite color to the overall direction. There are 3 major rules for identifying valid order blocks that will actually work in your favor. First, the block must create inefficiency. Inefficiency occurs when you see drastic price movements that create gaps between the candlestick shadows. You want to distinguish between efficient moves where price flows smoothly and inefficient moves that create these gaps. Second, the order block must lead to either a break of structure or change of character. These structural changes are the first clue that the market is revealing its intentions, whether it plans to continue in the same direction or completely reverse course. Third, the order block must remain unmitigated. Order blocks are one-time use opportunities, so you only look for trading setups when price tests an order block for the first time. Once an order block has been tested and failed, it loses its institutional significance. But here's where most traders struggle with order blocks. When you're looking at your charts, you'll often see multiple valid order blocks at different levels. How do you choose which one to trade? You might see a higher order block that looks appealing, but it could turn out to be too weak and price breaks right through it. Or you might focus on the lowest order block thinking it must be the strongest because it's the furthest from current price. But then price doesn't come all the way down to test it, causing you to miss profitable trades. This is where the inducement strategy comes into play. When a chart is moving in a clear direction, let's say bullish, it creates higher highs and higher lows. During this movement, you'll typically see multiple potential zones to enter long positions. Among these zones, you'll have inducement zones and true zones. An inducement zone is exactly what it sounds like, a trap. It's an area that looks appealing to retail traders, but in reality, represents a weak zone that won't hold when tested. The key to identifying inducement zones comes down to two critical factors: liquidity and imbalance. An imbalance is a price region that hasn't been tested. Here we see an imbalance below the lower zone. Price naturally wants to return and test these gaps because of liquidity. In fact, there are going to be stop losses from buyers wanting long positions, sell stops from breakout traders, and substantial institutional orders at the true zone below. We know this is institutional because major moves originate from these areas. Let me show you a real example. Here's a straightforward uptrend with higher highs and higher lows. During this move, three potential buying zones developed. If you were analyzing this chart right now, which zone would you choose? 1, 2, or 3? I immediately eliminate zone 1 because there's an untested area below it. Price will break through zone 1 to reach that gap, making it our trap zone. That leaves zones 2 and 3. You might think it's zone 3. It's the lowest, so probably strongest, and there's an untested area below that price wants to fill. But you'd be wrong about zone 3. Here's what most traders miss. Price formed a low here, then a higher high. After pulling back to create a higher low, price attempted to break the previous high, but barely managed a small wick penetration. This means zone 3 didn't provide enough buying power for a convincing break. However, zone 2 actually generated the institutional pressure needed to break through resistance convincingly. The lower zone isn't as powerful as it appears. The middle zone represents true institutional accumulation. Now we eliminate zone 3 and focus on the reliable zone. We want price to break the trap zone, adding significant liquidity to the market. After breaking the trap zone, we wait for price to reach our true zone. Switch to a lower time frame, from 1 hour down to 15 minutes for entry confirmation. Wait for a break of structure showing shift from bearish to bullish momentum. There's our signal. Next, wait for price to move toward an imbalance. Here's that region. This is where we enter. Return to higher time frame, set stop loss below the recent low, profit target at previous high. Let the trade develop. Just like that, a winning trade. The sixth and final concept that completes your professional toolkit is understanding liquidity and inducement. Every single market movement follows the same four-phase cycle over and over again. The accumulation phase occurs when price moves sideways at the bottom, while smart money quietly accumulates positions. The markup phase begins when price exits the range and starts making higher highs and higher lows. This is the trending phase where the easiest money is made. The distribution phase happens when price moves sideways at the top while smart money sells into strength. Finally, the markdown phase occurs when price breaks down and starts creating lower highs and lower lows, beginning the downtrend before the entire cycle repeats. Right before major moves begin, smart money creates traps through liquidity sweeps. Before the accumulation phase ends, you'll see a spring occur. This is a fake break below support, a liquidity grab designed to shake out sellers before the uptrend begins. Before the distribution phase ends, an upthrust occurs, a fake break above resistance that sweeps the highs and traps late buyers. But what is the liquidity? Liquidity represents accumulated capital or substantial pending orders that require execution. Markets must collect this liquidity to generate directional momentum. To survive as a profitable trader and avoid devastating losses, you must accurately identify liquidity accumulation zones on your charts. You can locate liquidity below equal lows and swing lows, above equal highs and swing highs, below or above dynamic trend lines or channels, and below or above order blocks. Now let's examine inducement, the mechanism institutions use to extract money from retail accounts. Inducement occurs at specific price levels, where traders believe conditions are perfect for entering trades based on their analysis and trading systems. Central banks and large institutions exploit these predictable behavioral patterns to lure retail traders into losing positions. Where do these inducement scenarios typically develop? Most commonly at order blocks, support and resistance levels, swing highs and swing lows, and trend lines. Let's start with order block inducement. As I explained earlier when we covered order blocks, these represent crucial supply and demand zones where price potentially reverses direction upon contact. These blocks contain numerous buy and sell orders, making them natural inducement points where traders get drawn into the market. Here's a perfect example. Price breaks recent market structure upward and creates this bullish order block. Traders immediately start looking for long positions by placing buy orders in this area because it appears to be a high probability reversal zone. But notice what actually happens. Price completely ignores this bullish order block. The zone proves invalid and fails all the traders who trusted it. This becomes a classic inducement scenario. We see another order block positioned lower on the chart. Again, price shows no respect for this level, making it invalid and another inducement trap that catches unsuspecting traders. As I mentioned when discussing the power zone selection method, the key is learning to distinguish between valid order blocks that institutions will defend versus inducement blocks designed to trap retail money. Support and resistance levels create another frequent inducement scenario. All traders view these levels as points where price should reverse direction and respect these boundaries whenever price returns to test them. This predictable thinking makes traders easy targets for inducement. Here's a major support zone where price has been rejected multiple times previously. Traders get induced into the market every time price approaches this area, hoping for another upward bounce. They place their buy orders at this support level and wait for the expected reversal. But watch what actually happens. Before moving higher, price drives down with a long wick, hitting the stop losses of all the buyers positioned at the support level. Only after collecting this retail liquidity does price rapidly surge upward. This represents pure inducement, a scenario specifically designed by market makers to extract money from predictable retail positioning. Swing highs and lows frequently behave as inducement points as well. These represent the extreme price levels recently reached, especially on higher time frames like the daily chart, where they carry more significance and price shows greater tendency to respect them. Retail traders consistently get induced into positions at these swing points. For example, on this daily time frame chart, we have this swing high representing the highest recent price level, and this swing low marking the lowest recent point. Most retail participants place buy and sell orders at these swing levels, expecting price to respect these areas and reverse direction when contacted. They believe these obvious levels provide reliable entry opportunities. Instead, price creates false breakouts at these areas, triggering the stop losses of both buyers and sellers before moving in the intended direction. We classify these as inducement scenarios because they systematically trap retail positioning. Trend lines represent the fourth major inducement mechanism. Trend lines connect swing highs or swing lows to display prevailing price direction. They provide visual representation of dynamic support and resistance across any time frame. Most retail traders view trend lines as potential entry points and get induced into positions when price approaches or breaks current trend line levels. Here we have a trend line that price has respected twice previously. Retail traders get induced and take short positions when price respects the trend line on the third contact, expecting continued downward pressure. Alternatively, if price breaks through the trend line, they look for long positions, believing the breakout signals upward continuation. Now, structure tells you where price wants to go. Indicators tell you when it's about to get there. They're not magic, they're confirmation tools. 3 families matter, and I'll show you the best ones from each. Momentum indicators and trend indicators. These analytical tools measure both trend direction and strength, performing optimally during strong trending market conditions. Key momentum tools include MACD, where upward line crossovers signal bullish trends, while downward crossovers indicate bearish trends. Moving averages work by showing that price above the average suggests bullish conditions, while price below suggests bearish conditions. Parabolic SAR displays dots. Dots positioned below price indicate bullish trends, while dots above price indicate bearish trends. Supertrend provides clear visual signals, with green indicating bullish conditions and red indicating bearish conditions. Oscillators. These tools measure price strength relative to recent ranges and work best during sideways or choppy market conditions. RSI stands out as a premier oscillator. When the line enters oversold territory, it suggests potential upward reversals. When it reaches overbought territory, it suggests potential downward reversals. Stochastic employs 2 lines. When both lines reach oversold levels, it signals potential upward reversals. When both lines reach overbought levels, it signals potential downward reversals. These lines can also cross each other to generate additional price direction signals. Volume indicators. These tools reveal the power behind price movements by analyzing trading volume data. Key volume tools include price volume, which shows volume for each individual candle. Longer volume bars indicate higher trading activity. Volume-weighted average price calculates the relationship between an asset's price and its total trading volume. You can trade this indicator like a moving average or use it as dynamic support and resistance levels. Volume profile presents volume data horizontally across different price levels, creating key zones for potential trade entries. But the real power of these indicators isn't the signals themselves. It's in what they reveal when they stop agreeing with price. That's called divergence, and it's the closest thing to seeing the future on a chart. Divergence. Divergence occurs when your indicator shows opposite signals compared to actual price movement. This contradiction often provides early warning signs that the current trend might be losing steam and preparing to reverse. You can spot divergences across multiple indicators using MACD, Stochastic, and RSI. Here's a practical example using MACD. Imagine price creating higher peaks, which appears bullish, but the MACD indicator simultaneously creates lower peaks, which appears bearish. This contradiction creates bearish divergence, warning you that price might reverse downward, creating a potential short selling opportunity. Divergence warns you that a move is losing steam, but there are 2 specific chart formations that tell you exactly what's coming next. Whether price is about to explode in one direction or completely flip around. Breakouts and reversals. Breakout patterns. Picture this scenario. Price gets trapped in a tight range, bouncing back and forth like a ping pong ball. Then suddenly, boom! It explodes through one side of that range with tremendous force. That explosive move is what we call a breakout. These powerful movements typically happen after the market has been stuck in what traders call a consolidation phase. Think of it like a spring being compressed. The longer it stays compressed, the more explosive the eventual release. Let me paint you a picture. Watch how price moves sideways in this tight range, going absolutely nowhere. Then observe what happens next. It bursts through the bottom with incredible momentum. This dramatic price explosion creates massive profit opportunities for those who know what to look for. Smart traders use recognizable chart formations to spot these explosive moves before they happen. The most reliable patterns include wedge formations, triangle setups, and rectangular consolidations. Each pattern tells you a unique story about where price wants to go next. Reversal patterns. Sometimes the market completely changes its mind and decides to head in the totally opposite direction from where it was going. These dramatic U-turns create what we call reversal patterns, and they're absolute gold mines for traders who can spot them early. Here's what separates the professionals from everyone else. They can recognize specific chart formations that signal these dramatic direction changes before they actually happen. The most powerful reversal signals include double peak and valley formations, triple peak and valley formations, the famous head and shoulders setup, and those beautiful cup and handle formations. Each formation has its own unique fingerprint and gives you clear warning signs that the market is about to flip directions. Master these patterns and you'll never get caught on the wrong side of a major reversal again. Now let's move on to the tools, and keep this simple because it really is simple. You need 3 things. TradingView for your charts. If you don't have it yet, I leave a link in the description. Open the super chart view. Put it on one side of your screen. A broker or exchange on the other side. For crypto, I recommend this exchange. A prop firm like this one will let you trade their capital once you pass an evaluation, which solves the starting capital problem for most people. And a trade journal. Every single trade logged, every setup, every result, every mistake. After your first profitable run, go back and ask, what did I do right? Then do exactly that, more. No $10,000 setup required. A laptop with Wi-Fi is genuinely all you need. Now let's talk about something nobody is honest about. The timeline. How long until you're profitable? It depends almost entirely on how much you practice, how seriously you journal, and how disciplined you are. Some people get consistent within a month. Others take 8 to 12 months. The difference is almost never intelligence. It's work ethic and discipline. Watching videos, including this one, is only step 1. Step 2 is sitting in front of the charts and doing it. Losing, learning, adjusting. Think of it like building houses. Your first is terrible. Your 5th is better. Your 100th is solid. The tools and the blueprint don't build the house. You do. You have to pick up the hammer. The path is not linear, but it has a pattern. Confusion, then pattern recognition, then consistency. Every profitable trader alive went through all 3. The markets will always be there. Opportunities don't disappear. They repeat every single day on every time frame. What separates you from a profitable trader right now is not information, it's experience. And experience is only built one way, by showing up, placing trades, treating losses as tuition, and refining your process every single session. Set your risk before every trade. Trade with the trend. Wait for price to come to your level. Let the trade play out. Do that consistently, and this works. That's all for this video. See you guys next time.